Good evening, everyone. Time for another silver update. This is the 8-hour chart of silver provided by netdania.com. You can click on the link below. Now, I've drawn a couple of lines here. This is a chart I featured on the blog. This is the 1-year price change from the bottom that we reached in December of last year to the potential bottom that we're at now. And you can see the other line here is the reset of the MACD. You can see that we are oversold to the point matching where we were oversold at the end of last year. So it's interesting that they have chosen this time. Now, I pointed out before that the Silver Eagles are not in production. So I don't believe you can lock in the price. I don't know the answer to that. If any of you do, let me know if the Mint allows you to lock in orders for the 2013 or if everything is frozen. So if we get a move like we had here, and let's pull off all of the indicators and just go back and look at the prices. And actually, we'll go ahead and put it on a daily so we can look at them real close. And if we go back to the end of the year last year, you can see that the days that these moves occurred, we had, and the trading days are going to be different because of how the weekends fall. So obviously the 31st was a weekend last year, but you had this move from about the 29 area down to 26 is the low. You can see you got this candlestick here, which means that the low that hit was down around 26, but it did not close down there. It actually only spiked in that day, and the low of the actually the open was 27 and the close was all the way up at 27.70. So you had one day to act there, about a $3 move, and then within 1, 2, 3, 4, 5 trading days it was all over. So are we going to see a repeat of that if we move in and look at, let me get the line off of there. If we move in and look at where we are right now, you can see on the daily we had significantly more days of selling starting around the 12th, and 1, 2, 3, 4, 5, 6 days of selling, and then we're getting some candlesticks now looking like bottom type formation. So a lot better buying opportunity for those that are stacking. If we do get a snapback to the tune of about that $3, then the snapback, if it's the equivalent of last year, is going to snap us back to around that 33, 34 in early January. So that will be the equivalent. We're still in that uptrend, although this is quite a setback. So for the stackers, it's a gift. For the paper traders, it's quite the loss if they had to cover at a loss. We're going to look at that when we look at some of the market issues and market control. So let's jump over to some questions, and then we'll get to the main topic. The first one's from Ivan, and he says, "Hey, Brother John F., every time I turn on CNBC, they talk about how people are sitting in cash and waiting. Do you think it's wise to hold some dollars in hopes of buying cheap stocks, bonds, real estate, corporate bonds when the next bubble bursts? Thanks, Ivan." Well, a couple of thoughts on that. When you're talking about sitting in cash, that's, as I've pointed out before, that's kind of a stock market term. What they mean by that, that's kind of coming from that terminal bullish view that your allocations are determined by how long you are stocks, and the way that you lighten up is to go into cash. Of course, that's a permanently bullish view because they never talk about being short and how much cash you have, just being long. And so becoming bearish means moving less or moving more money out of stocks, long stocks, and moving it into cash. That's their idea of taking a bear position, how much cash you stack up there. So That's a stock market concept. You can apply it to bonds, real estate, etc., waiting for a buy. But the question is, I would ask, if you look back for the last 5 years, maybe the last 10 years, I suppose you could have caught the 2009 March bottom if you were smart enough to sell all your stocks in the summer of 2008 and sit in cash all the way till March and then pile in. Of course, if you had that kind of timing, you'd probably be a billionaire hedge fund trader. So, most of the people who sit in cash are basically victims of financial repression because, as we know, the Federal Reserve and the governments of the world are squashing savers by forcing interest rates down to near zero levels, and they're rewarding the banks, but savers are not being rewarded. So for me, cash is just another piece of paper. Cash is paper. Stocks are paper. Bonds are paper. Real estate is a paper deed that you own some land, but that's subject to tax. Of course, corporate bonds are paper. So I don't really like paper. I like physical silver and gold, so that would be my vote on that. Next question. $2 trillion in deposits over loans, and that's from Miejo, and it's pointing to a Zero Hedge article. I'm not going to go to the article. It's a very long article. Basically, what it summarizes, well, let's go there so we can see the chart. What it summarizes is this difference between bank deposits and loans. And the summary says that the indirect implication of all this is those demanding that the money on the sidelines leave the sidelines and once again used by companies. Problem is that said money is already used by banks as a prop trading capital, likely all 2 trillion of it, and possibly being hypothecated. So this is showing you what the Fed is doing, and what the Fed is doing is it's loaning money to the banks, then paying them interest, basically loaning it at zero, paying them a small amount of interest, and it's just kind of a big musical chairs game, Ponzi scheme. I think what the Fed is trying to do is recapitalize the banks. The banks were pretty much in the same position as Lehman. It's just that they decided to call in their loans and not back them, so Lehman was destroyed. But really, all of the banks probably should have been destroyed, but the Fed stepped in, and now the Fed is pumping money into these bankrupt banks, letting them earn a small amount of interest, and that trying to keep that money from leaking out into the economy. Is it a success? No, I think it's a colossal failure, and we'll get to that topic when we get to the main topic of the night. Next question. Hedging to zero. This is from Dragonfly Doji. Hi, Brother John. I've always looked forward to your blog updates and videos. Thank you. I do believe there's a massive manipulation in these markets. However, with all the physical buying we know to be fact, I have a question. In order for Gainesville, Atmex, CMIs, etc. of the world to sell at these deflating prices to us, the retail investor, they must also need be sellers in the paper market as hedgers, equaling every ounce that is purchased, correct? But wouldn't their hedging selling drive the paper price down? Or would it be a wash with the buying coming in from physical demand? I assume they are never buying and standing for delivery due to the mint and bullion products they offer and sell. Been doing this for a while and do get the goal of stacking to take the metal off the market, but these retailers can just hedge and chase the price down, making no difference to their bottom line. Where is the breaking point? I still have a hard time wrapping my head around this whole price discovery thing and the hows of decoupling from physical and paper, what effect their hedging has. I hope this makes sense and you can elaborate or cover this more. So what he's referring to is the fact that the Atmexes and the Gainesvilles of the world, they have to operate in some type of hedged position. If you think about it, when we get a smackdown like we've had here recently, and it's quite possible that Gainesville or Atmex bought their silver around here or around here when there were steadier prices, and then we get this dramatic down move, And of course, I was in there snapping up the half-ounce dragons, and it's quite possible that APMEX or Gainesville or the others are selling those coins for less than what they bought them for. So the question becomes, how can you stay in business and make a profit if you're selling something for less than you bought it for? And of course, the answer is going to be hedging. So if you're a big player, you're going to have to hedge in the paper market, especially if you're arbitraging your silver to that market. As I pointed out before, we watch the net Dania price of silver very closely because it is arbitraged to the physical by outfits like APMEX and Gainesville. By the way, I believe Provident as well. I'm sure there are others, but one of the reasons why I watch APMEX so closely, and Gainesville too, but APMEX primarily, is because their prices are very, very closely linked to the paper price. They move their physical prices directly in line with the paper price. So if you're good at timing the paper sell-offs, then you're good at stacking physical metal from APMEX because you can buy those dips and get that discounted price. Now the big question is going to be, how are they hedging and who are they hedging through? Now if you remember when the MF Global collapse occurred, that was when Ann Barnhart shuttered her futures business. And I brought up the question at that time, ultimately, if we have these defaults in the paper futures market and the CME coming in saying basically a lot of finger pointing and everybody saying, well, it's not my problem. What that does is that destroys confidence in those futures markets. Did APMEX, Gainesville, or some of the other hedgers lose money? Were they going through MF Global? So if it becomes the case that these metal sellers, physical metal sellers, are no longer able to hedge their inventory through the paper markets, then are we going to start to see the sort of phenomenon that we see with your local coin dealer, which is often reported. People talk about how a lot of these guys seem to shut down. And if you go to them and try to buy physical silver at some of these coin stores after a massive or during a massive smackdown, they just kind of hold back and aren't willing to sell. Of course, they're not willing to sell at a loss. But then again, in a down market, how long are they willing to go without turning any inventory over? Because that's what they're in the business to do. So how do they hedge? How does the little coin store guy hedge? I don't know. You'd have to ask them. So that's going to be the big issue, and that's potentially the issue for a disconnect between the physical and the paper market, because if you take away the ability of the physical silver sellers to hedge, then they will not sell at prices below where they bought. They will only sell at prices above where they bought, because nobody's in the business of losing money. Everybody's in the business of making a profit. So that brings us to the main topic of the night, and that's something similar, and that's about markets and free markets and how they work. I'm going to start with an article that comes from Wealth Cycles, and this is Mike Maloney, and he's citing von Mises and the Austrians, and it's called Central Planning is Doomed for Lack of Price Intelligence. And he says, Ludwig von Mises teaches us the path to light by explaining why logically centrally planned economies throughout history have invariably failed. In short, all have an unsolvable economic calculation problem. In other words, no human planners can possibly attain the information and understanding that is contained in the most elemental aspect of the marketplace, price. And he digs into that further. Today, sectors of the global economy are partially planned and partially capitalistic, just as the economies of the Soviet Union and Eastern European were not fully socialist because they were essentially islands within a capitalist world market. The planners were therefore able, albeit clumsily and imperfectly, to use prices set by world markets as indispensable guidelines for the pricing and allocation of capital resources. Think about the mines, for example, Russia mining palladium or whatever they're mining. We know about the collapsing standards of living for the more heavily planned economies, North Korea, the Soviet Union, East Germany. Hunger, war, and death mar the track records of the planners. So keep that in mind here, because I'm going to make the argument that the United States is actually on the path of hunger, war, and death, because we're on the path of the central planners. Now, the hot idea being learned today firsthand in China and being bleached away at this point within the U.S. evolution is the foundation of Deng Xiaoping's catchphrase, "To get rich is glorious." We find the concept of profit to be far from evil as it is portrayed. Rather, profit embodies the preferences of consumers and results from the relationship of costs to prices, not only instructing us in which goods are most economical to make, but the most economical ways to make them, benefiting everyone's well-being. Lastly, the profit test is the best way to align incentives in a free society, when I will comment that we are rapidly moving away from. If somebody wastes resources combining them in a way consumers do not care for, he or she will incur losses and be forced to change or discontinue plans. Now, with a better understanding of the rational allocation of resources provided by free prices, consider how difficult it would be for an individual or group of planners to figure out all the aspects of value for each factor of production that exists in an economy. Then consider the possible innovations and inventions not yet in existence that should be developed and planned for. It is possible that entrepreneurs in a free market, incentivized by profit, might seek to innovate and improve at a more rapid pace than the smartest, best-intentioned government workers. So that's the idea. It's really not complex, but I wanted to shell it out a little bit more. Now, this is from a post that was on Zero Hedge, but it comes from Simon Black. Simon Black is the I don't really understand, much hated and abused character on Zero Hedge. I greatly respect the man. He's an expat. I think he's anonymous. I don't really know who he is. I think that's a name he chose, but he sees a very sharp decline of the West. And what's very interesting is this informational chart that he posts in this article. Now, what these circles represent is the wealth or GDP or the size of the economies, essentially. And the color coding is the difference between those that are growing and those that are shrinking. Now, what is fascinating about this is how this fits in with my analysis, as I pointed out in the last couple of videos, that what I believe we're seeing is actually the collapse of collectivism. We're seeing the collapse of central planning, and it's just moving through the last bastions of that. So we have here the Soviet Union. That's a big blue. Blue is positive growth. Red is negative growth. Orange is somewhat negative, and then light blue is somewhat positive. So you can see that the Soviet Union is now in the positive column with a big circle there. They have already tried collectivism and central planning, and it failed. It collapsed their economy. They're now moving more towards a free market mechanism. Same thing with here in the Middle East with Dubai. You see it in India, and you see it in China. You see it surprisingly here in Mexico, and you see it in Texas, and you see it down there in Chile where Simon Black is. Now, the big red dots are here in Europe, and the collapse of the European economies, that's the big story. But the next in line is America and Japan. So it's no coincidence in my mind that the last of the socialist or centrally planned or collectivist ways of doing things, the United States with the election of Obama and the move farther to the left, is actually the lead player moving towards the leftist view of things, collectivism, central planning, whereas Europe is now about where the Soviet Union and China were when they're right before the collectivism and central planning just completely collapsed and went into poverty. And then, of course, you have to rise out of that, which they're doing now. So we're going to see poverty hit in Europe and collapse, then Japan, and then the United States. These are the last collectivist, centrally planned economies. The idea will be discredited. People like Obama, Geithner, Bernanke, central planners, collectivists will be discredited and ultimately go down in history as the proponents of a failed system. Now let me show you how and why that is a failed system. I want to show you through a little bit of a different concept here. This is the concept of distributed computing. Basically, in the past, supercomputers were something that you built like a giant Cray or something at Texas Instruments or something at the Pentagon or something at the Smithsonian. Just a giant machine, and it was able to do all these calculations with that computing power. Now we have distributed computing, and basically what that is making a supercomputer by participation. We have the ability now with things like the internet, networks, and the way we can divide out processors. If you look at your processor on your computer now, you actually have 4, 8 processors, and they're working on different things at different times. But you can share that load and in essence create a supercomputer. The Bitcoin network in a way is sort of protected by that supercomputer concept. When all the miners are added together, you actually have the power of a supercomputer. So distributed computing is a field of computer science that studies distributed systems. A distributed system consists of multiple autonomous computers that communicate through a computer network. Computers interact with each other in order to achieve a common goal. A computer program that runs a distributed system is called a distributed program. Distributed programming is the process of writing such programs. Distributed computing also refers to the use of distributed systems to solve computational problems. Now that's what you have with the Bitcoin, with mining pools trying to solve the next blockchain. You also have that with some of the projects, shared computing projects. You have that in study of galaxies. You have that in all kinds of science projects where this distributed computing is used to solve these, and you can share off a percentage of your processor if you want to one of those shared goals. So why am I bringing this up? Well, the reason I'm bringing this up is because in my mind the market mechanism is essentially a biological or carbon-based distributed computing system. In other words, the market is the collective decisions, wants, needs, values of millions and billions of people, and it's all being calculated by supply, demand, ultimately determining price. And that brings us back to the article from Mike Maloney, and the idea is that to disregard the supercomputing power, the power of the pricing mechanism, is to basically disregard and throw away the value of that supercomputer. So you can imagine if you had an economy that was competing with another economy, and one had the power of a supercomputer to do calculations, and the other one was using an abacus or a guy sitting in a room with a calculator. You can imagine how one would greatly excel above the other. That's in essence what you have when you have economies competing, where one has market determination of prices, the other one has central planning. Ultimately, the centrally planned economy is doomed because it simply cannot compete. And that's what explains the anomaly of China and Russia. A lot of people confuse the fact that China and Russia and some of these other countries, even the Middle Eastern countries, have particular political systems and they have particular control structures. That's irrelevant to this concept. The concept is, do those governments recognize the power of the distributed computing power of the market? Do they recognize that the market is a tool that they can use to provide them information about decisions that need to be made? So the more that governments adopt this type of distributed computing power of the market and price, the more they will prosper. The more that governments adopt central planning and decisions based upon committee, the more that those economies will be impoverished. So what we're seeing in the United States now, the silver price is a perfect example. The silver price is an example of central planning. That is because the central planners had decided that the price of silver and the price of gold also are determiners of confidence in the centrally planned economy and its currency, which is rapidly being devalued, and therefore those indicators must be squashed. Just as has been reported recently, the indicators of who's moving from what states to others, we're now seeing an exodus of people from California. If you've been following the news, we've seen Gerard Depardieu leaving France, and because obviously people are going to react to having a large amount of their wealth confiscated by governments, and of course that is going to be a market as well. So now we see the government not reporting the figures of which people are fleeing from which states to others. We know that people are fleeing California and the eastern areas, and they are flooding into Texas. I think you have a spot there in Colorado. There's still a little bit growth there in California, but the big growth there obviously is in Texas, which has low taxes, no state income tax. And so we're seeing people flee from those states, and what's happening is the central planners have decided that rather than admit that their model is broken, it doesn't work, it creates poverty, they would rather squelch the facts and the evidence, just as was pointed out recently that Stalin had the census takers shot by firing squads. When they came back and reported the results, was that the population was shrinking, of course, because of his horrible central planning, which caused the starvation of millions in Russia, also caused the starvations of tens of millions in China, because central planning simply doesn't work. So ultimately, central planning is going to be exposed for the bankrupt idea that it is, and I believe the market will win out. I believe when the market price of silver wins out, we're going to see a true market price of physical silver in the triple and potentially even quadruple digits, because the central planners have been suppressing its price longer than any other commodity. It's the most suppressed, the most centrally planned, and ultimately when the market wins out, it will be the most explosive. And we'll talk to you next time.